Welcome back, and joining me with more insights on the day's trade is Annatjie Van Rooyen from Regenesys Business School. Annatjie, thanks so much for your time today. So lots happening this week from those private sector jobs number in the US. We've seen a bit of a tech sell-off as well, and the US government shutdown entering day 38. What stuck out for you the most? Of course, on the back of the volatility that we have been seeing, is it something to be concerned about or a healthy breather when it comes to those equity markets?
Good afternoon, Annatjie. Thank you for having me on your show. Yes, as you have mentioned, we're seeing some risk aversion creeping in, and this is on the back of softer global market performances, but also disappointing trade numbers from China earlier today, as front loading has tapered off in October, and of course those export curbs were implemented on rare earth minerals prior to the recent trade truce between the US and China. So it's not all bad news. We also had some good news recently. But unfortunately, these headwinds also are underpinned by a sell-off in the US tech stocks and some uncertainty relating to this government shutdown that started on the 1st of October and it's still continuing. So we're not going to get the non-farm payroll numbers this afternoon. And at the previous Fed policy statement, they were pretty cautious. And as we know, they are data dependent. But markets are still building in a probability or betting on a probability of 63% that we will see a 25 basis point cut in December. And this, as you have mentioned, is because of the latest challenger job cuts, which came in at its third highest level since 2020. So on that US tech side, we're seeing a pullback, and we haven't seen major sell-offs. So those companies still had solid earnings reports, but those valuations are stretched. And I personally think that these pullbacks are healthy and they don't necessarily point to a crisis. And you got to look at the results. 83% of US companies have exceeded earnings growth expectations. So the AI valuations are elevated, but the earnings base is much stronger than during the dot-com bubble, which everybody is referring to at the moment. So even though those P's are high, it's not unprecedented.
And how concerned are you about the U.S. growth picture? Worries had infiltrated markets yet again on the back of a softer labor market. We saw those ADP numbers, and we've also heard from some of these big tech counters cutting jobs as well.
Yes, but a lot of the guys are saying that the job cuts are related to jobs that's being replaced by AI, and I think that makes a lot of sense. So I'm not that concerned about the economic growth especially in the largest economy, which is the US, especially with that big beautiful bill running in the background. I'm not too concerned about that. I am a little bit concerned about the jobs market there, but inflation is still running above 2%. I don't think we need to be concerned about the economic growth just yet.
And looking at China, you touched on those export figures coming in lower, slipping 1% in October as shipments to the US declined by 25%. You did speak about that front-loading activity, and we're starting to see that tapering off. Just further thoughts on that. Are we starting to see perhaps a normalized picture when it comes to those export levels in China?
Yes, I think you're 100% right. I think the levels are normalizing. And remember, those export curbs were also in place. So maybe we're not at normal levels just yet.
Okay.
But yeah, I doubt whether China is going to make that 5% growth level for the year. That remains to be seen, but I think they're going to get pretty close to that.
All right, let's take a look at what's playing out here at home. Quite a slow company news day, but we did get numbers out from TFG. Quite disappointing, reporting a 21% decline in earnings, struggling in key markets, including here at home, that being South Africa. Walk me through just your analysis of that print and whether you think it just speaks to the consumer in South Africa. We've seen also downbeat updates from Truworths. I think the only really good update from the retailer side, the clothing retailer side this week, was Pepkor's one.
Yes, Foschini Group, it was a mixed result with, as you have mentioned, 21% drop in headline earnings per share. but that result still came in towards the upper end of the guided range, so it's not all bad news there. Revenue was up to 31.4 billion versus FactSet expected 29.2 billion, and sales up 12.7% to 29.2 billion. This was also slightly better than guided for.
Okay.
This result was largely driven by the acquisition of White Stuff in the UK. They have seen online sales surging 55%. It's now contributing 14.7% of total retail sales. Despite strong top-line growth, operating profit fell 9.9%. This was reflecting margin pressure from clearance, markdowns, and negative operating leverage. Regionally, TFG Africa grew sales by 5.3% due to subdued consumer sentiment, while TFG London posted a 69% increase in GBP sales, but it would have been only 0.7% if you exclude White Stuff. And then Australia contracted slightly by 0.5% in Aussie dollars. Looking ahead, they expect trading conditions to remain challenging, but they'll focus on operational resilience, cost control, and digital channels to drive their growth. Now, I do think that the South African apparel retailers are still competing heavily with the Chinese imports. And it's causing a big headache for them.
The likes of Shein and Temu really coming in and eating their market
100%.
share. Quickly, before I let you go, your stock pick, Annatjie.
Well, I want to move into the eye of the storm. I don't know if it's a storm in a teacup or a hurricane. That remains to be seen. But with $420 billion worth of capex being pumped into AI development during the next financial year, just between Meta, Microsoft, and Amazon, we feel comfortable to stagger purchases into pullbacks. Microsoft's down 3% in October, but up 18% year to date. The world's leading technology company with products that include Windows operating system, the Office 365 suite, the Azure cloud service offering. It also owns LinkedIn and has a stake in the gaming industry. And then guidance for second quarter 2026 remains solid, with top-line expectations in line with consensus at the midpoint. Most divisions are expected to exceed expectations. Microsoft's trading on a forward PE of 29.8 times, which seems fair relative to its long-term history. It remains a key beneficiary of the growing digital transition, and Office products account for more than 25% of sales, and this provides the company with annuity income that continues to grow strongly. So dominance in cloud infrastructure positions this company as a top hybrid cloud provider, and investment in OpenAI could lead steady improvement across most of its products. So I'm going to go with Microsoft.
Microsoft, one to look out for. Annatjie, thanks so much for your time and your insights today. That was Annatjie Van Rooyen from Regenesys Business School.